Okay, welcome everybody to Wall Street Reporter's next Super Stack live stream for May 13th. We are back with ESE Entertainment, Conrad Vasela. Conrad, welcome back.
I'm back, Jack. How's it going?
Fantastic. You're back actually with some very solid news. You get a new acquisition, which we're going to get into all the details and everything. But for anybody that's just tuning in for the first time, our goal with this live stream is to bring you those stocks which have that 10x to 100x upside potential. Companies going after three things: multi-billion-dollar market opportunities. They're at a key inflection point, and there are multiple catalysts in place. And ESE is a perfect example of that 10-bagger plus. So far, ESE, I think, have you been a 14? You're so far at a 14x. At the peak. I mean, there's been a pullback, with a market correction, but so when Conrad, when you came onto our platform, you had obviously all three of those things. The stock was, I think, 28, 30 cents. You hit a high of 450 just last month. Now we had a bit of the market things are on sale right now. The tech stocks have been on sale since February. So your stock is still up. What is it, 5x?
It's roughly around that, but what a great time to get into the deal, right? You saw the potential. It ripped almost to $5. What a great time to get back in, load up on some shares, because I'm gonna say it and keep saying it, we're just getting started. Billion plus is the goal, and I said there's a little bit of a storm coming. Well, we'll start with today, and there's more coming.
Perfect. Yeah. So it's very interesting because right now the stock is pretty much what is it? It's kind of where you were almost in January. But I mean, there's been so much value created just in the last few months, and now you have everything is actually starting to kick in now. Back in was it in January when you came on? You said you had 100. Your goal was to I think to get to 100 million in the next 12 months or so. Run rate. You had a whole bunch of deals in the pipeline, 100 million plus revenues in the M&A pipeline. You closed the infrastructure deal, which was about 14 million Canadian last month. You're announcing a new deal, which we're going to get into all the details. I think you got some other things cooking, but I think we should start off with the new director you brought on, Rick Brace. So explain to us, his background and how he got involved and why you brought him in. Like, what's the connection here? And then we'll go into all the exciting details.
Yeah, I mean, if that doesn't get you fired up, then nothing will. I mean, from an actual operator standpoint, Rick Brace has built two multi-billion-dollar companies. Most recently, Rogers. He was a president of Rogers Media, listed on the TSC and on the NASDAQ. They're roughly sitting at about a $30 billion market cap. And this is an individual that has helped build those companies from the ground level and get them to the point where they are now. Talk about a mentor, talk about a Rolodex, an individual that could come in and really help us drive to $1 billion plus. I mean, it doesn't take a genius to figure out guys like this do not come onto companies unless they see massive potential. And with conversations I've had with him, he knows where we're heading. He believes in the vision, $1 billion plus, and he's eager to get involved. And it's been phenomenal. He's been very hands-on, and we haven't even scratched the surface of tapping into his network. And when we do, we're just going to continue to snowball in an upward trajectory.
Okay, no, it's really, I mean, look, it's one of the key things is to surround yourself with with the right people, with the right guides who've been there, who've done it. I mean, and this is the guy. I mean, he's been there, done on a massive scale. This is the guy at the top of his game. So I think there's going to be a lot of value add. What do you kind of bounce ideas off him when you're looking at these acquisitions, things like that, like in terms of strategy? Like how involved does he get? Like what's kind of the
Yeah, no, and this is the exciting part. He's a very active director, and he made it crystal clear from day one. He wants to be involved in M&As. He wants to be involved in business development. He wants to open up that Rolodex. Like, it's just exciting that he's so, eager to get involved. And he said towards the latter part of his years at Rogers, there was a massive uptick in esports and gaming and the conversations around this industry. And he knows it's the next big thing. Like we always talked about on the show, this is a generational opportunity, especially with mobile gaming coming on hard. His background in the media and telecom side, I mean, this is a home run opportunity, right?
Like in terms of like the rights, the media rights, that's like part of his thing, right? So that's
oh yeah. You want to talk about lineage? I mean, he's done deals with the NFL, NBA, MLB, Olympics. It's as big as it gets. This guy's been at the pinnacle of the game for so long, and we're just all ears and just, let's make things happen. And we're very eager to just, like I said, open up that Rolodex and execute.
Okay, excellent. So speaking of execution, you announced today LOI, this new acquisition. What is it? Give us the details on this.
I think the name kind of gives it away, but they're called Digital Motorsports. Okay, this is a booming group with a portfolio of intellectual property. They have a cloud-based racing service. They build their own simulators. They're an A to Z solution, tech and peripherals and actual simulators for the digital motorsports sector. And they're at the forefront of it. And combined with what we're already doing in this space, the vision is simple from both sides. We want to be the #1 digital motorsports and esports group in the world. And they share that same vision. And it just allows us to do it that much faster with these guys.
So it's okay. So really, you kind of like right now you're involved. You have like you're very involved like in the motorsports side right now in esports and kind of that motorsports sim racing focus. So what kind of synergy? So what kind of synergies are there with this new group? And is this? I mean, like, how are you going to be able to leverage this? And like, what's the upside?
Yeah.
And what are they doing in revenues? What kind of numbers are they? That's the big idea. That's the big question everybody has. What's the numbers?
Well, let's start with the numbers. The exciting part, approximate run rate for this year is going to be about 5 million Canadian, but most importantly, profitable.
Okay.
And they have great margins, and that's why we're so eager to invest more into the digital motorsports side of the business, because it's huge upside and it's a very profitable side of the business. We've seen upwards of 30% plus profitability margins on the digital motorsports side of our business. They're doing similar numbers. So we want to continue to expand, and we think the market is primed for consolidation. And with putting pieces of the puzzle like this together, we're really consolidating Europe in a hurry. They do a lot of.
These guys are based. They're in Ireland, right?
Correct, but they're European wide, right? They're running European scale tournaments. They have partnerships throughout all of Europe. They have distribution globally. They're headquartered in Ireland, but they're moving fast. We're talking 100% year-over-year growth, and with our synergies, I mean, we're gonna really take off.
Okay, so the takeaways, which this wasn't mentioned in the press release, so this is actually valuable information people are getting in this live stream. I hope you can talk about it. Okay, so 5 million revenues, which is pretty substantial. Look, in this space, this is not the esports space still is that's a pretty big number. There's not a lot of guys who are generating big numbers, so it counts. So you're doing the 14 million with the other thing. So you're getting close. I mean, you're basically, if I'm doing my math correctly, you're about 20. You can be 20-25% of the way towards your goal of the 100 million, and we're already in May. So you could pull it off. You could pull it off still. The 100 million by the end of 21.
like I said, those are historical numbers for those groups. I
7
think,
months.
yeah, and those are approximate numbers, but proof's in the pudding. When the actual financials come out and you guys are going to start seeing these numbers, it's not about pulling it off, Jack. We're going to do this. We're going to get 100 million revenue. We're going to push towards that $1 billion plus market cap, and we're going to continue to grow.
Okay. And what can you talk about the terms of the deal? Like, what's in the what's how much you're paying for this?
Yeah, we can't get into any specifics right now. We're going to be working on the definitive agreement, and we'll happily release all the details. But rest assured, it's aligned with our strategy, more based on shares and less capital outlay. So it keeps the structure tight, keeps the company sound. So it's in line with what we've been doing from day one and what we're going to continue to do moving forward.
Okay. Now here's what's interesting. Now, why do you have such a big focus on motorsports? And is that going to be more? Are you going to be kind of like building a dominant position in motor? Is that going to be like your focus initially to kind of dominate motorsports of the way esports motorsports? Is that like is that kind of the goal here, or what's?
Yeah, I mean it's our goal becoming a dominant esports company, right? A whole 360 solution, and the digital motorsports is just one of our pillars. A great comparable is you see motorsports games on the NASDAQ. They're hyper focused only on digital motorsports. It's a 250 plus million market cap company, roughly a $20 stock on the NASDAQ.
What's the symbol? Which one?
Motorsports games.
Motorsports games. Okay.
So that's a great comparable. We're going to do similar revenue numbers to them just based on what we're doing on the motorsport side with our business, right? And it's just one of the pillars that we have. So it really gives you context into how aggressive we're going to go into that space and how well we're doing in that space.
Okay. One of the other things is that I mean, like, I think you have a deal with is like Porsche, a couple of other major brands in this space. So I'm thinking that in the motorsports area, there's a lot of I mean, when it comes to advertising, brand sponsors, all that stuff, there's a lot more money because you have companies which have a lot of money to spend. Formula One has always been like the big money type of advertising and all that. I mean, I think it's bigger than like the NFL, really, isn't it big? I mean.
It's huge.
Yeah.
That is another reason why we're going to dive into this space. I really enjoy this space. I've been involved in, racing, digital motorsports for a long time. But you hit the nail on the head. Look at the quality of partnerships. Porsche, Kia Motors. We're working on deals with Mercedes-Benz. Multi-billion-dollar groups. But also some of the biggest brand recognition across the world. You mentioned Formula One as well, NASCAR, MotoGP, Indy. This is an entire ecosystem, like you said, that is bigger than NFL because it encompasses more, right? There's rally cars.
It's global, yeah. It's
massive. It's massive.
And this is what's interesting also is that because it's kind of the it's something where you have the brand. It's all kind of all interconnected. So
you know what it is, Jack? It's tier one. That's what it is. It's tier one. When you look at the sponsors in digital motorsports, you're talking about the Rolexes of the world, high-end brands, the real money, man. This is big time European money, global money that's entering into that space. And they know. I've had conversations with them. They know Gen Z is the future. Millennials, they need to attack them now. And they got to go with esports to get them, right?
And what's interesting is that especially the automakers, they're really focused on Gen Z and millennials because I think a lot of kids today, they're not as excited about cars as they used to be. It's like they're not. It's sort of it's one of those things where they're not. They're like, the cars they drive. They're not. They're not. It's not like one of those things where there's like a generational thing, and I think the brands really need to they got to start the marketing right now. Otherwise, they're going to be left behind.
And you're 100% right. And there's no better example. Google it. Lamborghini just came in hard with Rocket League. They did a whole branding campaign with Lamborghini. I mean, we're talking tier 1 stuff, right? And they're going really big into the space.
Okay, interesting. Okay, so you got this, and when is this deal? When do you anticipate this new acquisition to close?
So, we obviously have to go through the definitive agreement, go through some legal due diligence, etc. Approximately, call it 2-3 months on the high end. We're going to be working diligently to get this thing done faster, obviously, but we just have to go through the necessary steps to close. But both sides, myself and Digital Motorsports team, are keen and eager to get to work and get this done as soon as possible.
Okay. So would you say 60 days probably, or?
I'd say approximately 60 to 90 days.
Okay,
Fair to say. Yeah.
Fair enough. Yeah, because I mean, things sometimes. Yeah, I mean, like the infrastructure deal took a couple months to close. Okay, excellent. Okay, and interesting. Okay, so just kind of to recap, like right now, before this deal, I mean, what's the share count? Like, what's the market cap of the companies now? Like, how many shares out now, approximately?
Approximately 50 million shares out. Approximate market cap, roughly, 90 million, kind of hovering around that level. But I mean, you look at the comparables, you look
6x. So basically, you're trading at 6 times, which is about a third, maybe a half to a third of what some of the peers are at.
Yeah, I mean, approximately around that, right? Like 5-6x. But the reality is, you look at the comparables, and you see the $1 billion market caps, EGLX, Score Gaming. You look at some of these groups, and you just say, what an opportunity to get in at the ground floor, right? We're 10x from here. That's the goal from our side, right?
It's very interesting that like right now, like the EGLX, like they're getting a lot of attention recently. They're on they got onto NASDAQ finally, and but there is a lot of similarities in where you are now and kind of where they were, about, I don't know, 18 months ago, maybe 24 months ago, roughly. So it's like it's kind of a similar path, and it was all based on acquisitions for the most part.
Yeah, and they've done a phenomenal job, and we follow them closely. And it's actually eerily similar. They were kind of stuck in the $1.50 to $2 range for quite some time, and then they went on a bit of a acquisition tear and just started to build those pieces up and up and up, and now they're on the NASDAQ and billion-plus market cap. So congratulations to them, but we're next in line. It's our turn now, and they've kind of put out the blueprint, but I think we could do it faster and leaner. And that's our goal.
Okay, and actually, so there's a couple of things also. Like you have like your you have your team, right? You got esports team, they got a team. So there's a lot of I mean, they have a slightly different focus, which is more like media stuff. It's more of the you're doing the actual. So it's a little different, but it's a lot of kind of similarities. So it's interesting. There's there's a couple of ETFs now in the space. The esports, the video game ETFs happening, and this actually ties in here. So user 007, no, NASDAQ. So I think if you can get a NASDAQ listing at some point in the next 6 months, that would also make the stock more attractive for these these ETFs and everybody else. And again, there's not that many pure play esports deals on NASDAQ.
Exactly.
Which is why the EGLX is getting some traction. There's not a lot of
and let's take it one step further. There's not a lot of pure play esports company that actually generate revenue or profit. So that's our huge differentiator. We're actually generating revenues, and we're focused on getting to profitability, right? So break even profitability as soon as we can. You'll be hard pressed to find groups that are doing that. And as it pertains to NASDAQ, I mean, it's obviously a goal of the company to make it to the highest level and one day list NASDAQ, but we got to take care of business first, keep building on this story, We got a lot of chips to add on. Like I said, I keep saying it. I got 100 million in the revenue pipeline, in revenues, in the M&A pipeline. Guess what? That hasn't changed. We got to keep knocking these down. There's an example of one today. We got to keep getting through this and just keep acquiring. So that's why I'm saying this is a ground floor opportunity right now.
Well, okay, so this deal is going to close, probably next, 60, 90 days. What else do you have? What else are you looking at in the pipeline?
I'll just smile a little bit, but I said a storm's coming, guys. This is a teaser. There's more to come.
Okay. Excellent.
So be patient, but when I come on the show, it's real and we bring real news, and we're building a monster here, guys. So buckle up. This is a deal you want to stay in long, and now is a great time to get in.
Okay. No, it's pretty interesting actually, and the stock has actually held up surprisingly well with this, with the current market meltdown. A lot of our high flyers are down 60% plus 70%. It's been, like everything has been taking a beating. Of course, when things turn, everything goes the same percentage wise. But what's kind of right? I want to kind of wrap up with maybe give a quick recap. What some of the other growth initiatives you have, give us kind of like an update on what's happening with the esports teams, all the other, the brands, everything else.
Yeah, absolutely. I think I wanted to highlight on a big news release we had last week, and I don't think we got the credit we deserved. We did a deal with Bitcoin Vault. We signed a 7-figure contract. It was, roughly over just $1 million to roll out a really cool initiative. So we're doing a reality TV show for esports and gaming, and we're rolling that out in Japan, Korea, Vietnam, and Brazil. So, we're signing big contracts here. We're doing huge things. Unfortunately, it just isn't actually reading the news releases here clearly, because these are huge things, right? And they set the foundation for bigger contracts in the future, multi-million-dollar contracts in the future. So that's something that was really exciting recently. Our team Kick has been doing phenomenally well. They're entering into some big tournaments. We have some really cool news coming up, actually within the next few days. So keep your ears peeled for that. And just in general, we're building. From an organic standpoint, every month we're building and growing. We have new contracts, new initiatives in place. It's just a really exciting time for this sector, and we see so much growth. It's unbelievable. Even in speaking with the guys at WPG, our acquisition, they had their best month ever last month. So, if that doesn't tell you something, nothing will, right? So we're really working together, growing month over month. And these acquisitions, I'm telling you, they're just going to continue to bolt on and add that extra value. And the pipeline is robust.
So I think one of the key things also is, and I think people probably will see more of that down in the next few months, is that it's not just, you're not just making acquisitions just like you're creating value. There's synergies. Like there's thought into it, because like this motorsports things ties into your existing motorsports kind of portfolio. So these things have, there's a lot of synergies here, ways to leverage all these things. So it's
all synergistic, and we're staying in line with what we said. Accretive groups that are profitable. We're adding onto the bottom line. We're making money. That's what it's all about. We're going to continue to do that with these groups, but the synergies are, it's crystal clear. Like I said, WPG had their best month ever, and we just closed the deal. Big surprise, right? That's the type of deals we like to do.
Okay, excellent, Conrad. Let's wrap up here. Two things. One is, what do you have in the pipeline coming up? Like what can we look forward to hearing in the next, let's call it, 4 to 6 weeks?
Yeah, I think it's just best to follow the story. We're always putting out quality news, but we are going to be very aggressive on the acquisition trail. So really stay in tune with the story. and get acquainted with our current acquisitions. And I think it's just, like I said, this is a ground floor opportunity, guys. Hopefully you could read it in my face, but it's time to support and think longer term here, because we got some really interesting stuff coming up in the pipeline.
Okay, so on that note, last question we always like to ask is, okay, based on what you have right now, top 3 reasons why investors, should consider ESE today. Actually, before you actually say anything, I should add that, so far you've been right, because when you first came on, from the day one till up till the peak, the stock was up 14x or I forgot. I think 14x. So whoever's watching, pay attention to what Conrad is going to say now. This is another. You have a chance. This is another bite at the apple. These things don't go straight up. They go up, and then they crash, and they go up again higher. That's the way. That's just the way it works. So
that's the way it works.
Let's hear what top 3 reasons today.
We're gonna keep it consistent. Multi-billion-dollar opportunity. This is a generational opportunity. ESE is a billion-plus market cap opportunity. And number 3, you want to be a part of a group that's lean, has a tight structure, and that has a massive M&A pipeline and ready to execute. And actions speak louder than words. We continue to execute, we continue to deliver, and guys, this is ground floor opportunity. As Jack said, it's another opportunity to get in and position yourself wisely for future growth.
Excellent. Conrad, on that note, I want to thank you, and we look forward to hearing more from you, hopefully in the next couple of weeks.
Yeah, I always love being on, and excited to be back on soon.
Fantastic. Conrad, thank you again.
Have a great day, everyone.
Okay, let's get ready for our next presenter here. Let me just put our little countdown here. All right, Prad, I had to do that countdown thing because I wasn't following the news. I know you had some news. I had to take a quick break, look at my screen to see if you had the news, and there you have it. Big day today, big milestone.
Talk about right down to the wire. Yeah.
Look, I saw the stock was halted. I was like, is he going to have news? What is going to
Yeah, I was thinking the same thing. I'm like, when is this thing crossing? This shouldn't take this long.
Fantastic. All right. So welcome everybody to Wall Street Reporter's next Super Stock live stream. I don't know if there's a better, I think this is the perfect name. Next Super Stock, and literally, you are the next Super Stock. You start off at, what is it? The stock was, 50 cents, and went to 2 and change.
Well, if you go back to where I can remember, it's like 6 cents. So
yeah, well, that's before. That's before us. But actually, one of your big investors, Sean, he was on our Smart Money live chat talk about, and he's a big fan of. He's still in it. He's waiting for $10.
Yeah. I'm a big fan of Sean. Listen, Sean was there during the days that were really dark, and was supportive and stayed on us, and would give us words of encouragement and just stay focused. And he was long term, and look, I'm glad it's paying off for him, because he has hopefully done quite well. And Sean and I talk often enough to know that he really understands the business, and he understands the long term prospect. And yeah, look, it's the kind of shareholders you want, right? The guys that believe in the long-term vision.
Yeah, he's not a guy looking to make a double or triple. He's like a long-term guy who gets in, builds a big position, and he's looking for that 100x, 50, and he's not he's basically expecting at least $10 on SHG. So we're getting close.
We gotta give it to him.
Yeah, so now this is the big day. So you got the conditional. I just took a quick look at so what's the news is what you have conditional approval for NASDAQ.
We do. This is the last gating item. I mean, we got the no comment letter from the SEC probably about a week ago. And we actually got our no comment letter from the first examiner at the NASDAQ, but then there's a process to get through a secondary. And then, essentially once you receive conditional, there's a few items you got to clear, but these are usually sort of, the last minute items that you just do prior to uplisting. So, yeah, I mean, we're excited. This was what we were all waiting for internally. I'm sure this is what everybody on the outside is waiting for as well. This is game time. I mean, I said it before, this isn't a destination either. Okay. So I'm not looking at this and going, this is it. No, this is just really important.
This is really the start. This is really when the game begins.
This is such a major catalyst because, the more we keep marketing, the more we just keep hearing from institutions that look at the guys that you sort of comp with and Oak Street and Agilon and Privia that just went live. And, they're all coming out at like 4 or 5 billion market cap. Agilon is 12 billion. And everyone's looking and going, how do we get in early? Because private equity kind of owns this market. And here comes Skylight with an opportunity to be there at, a $200 million market cap with the same sort of destination and same market and same comparables. We're trading at 4 times, they're trading at 12 times. I mean, this is such a major catalyst to bring on true institutional investors that are going to support, our story, and this is going to be good for everybody. We're just really excited because obviously
the thing is there's just so many catalysts. Okay, so just to recap, the thing is here, our goal again is the next super stocks to bring the investors those super stocks which have that 10x to 100x, and they all have 3 things in common. One is multi-billion-dollar market opportunities that they're going after, which is what Skylight is doing. They're at a key inflection point, which is Skylight was and is getting it's already you're hitting all the acquisitions, and there are multiple catalysts to create big value. So I mean, you mentioned there's so many catalysts. I mean, one of them is this just internally. Now that you're a NASDAQ, right? Well, you're going to be a NASDAQ, and basically you're going to do the reverse. We'll talk about the details of that next week. I think it's going to happen, or tomorrow. When is it going to be?
We're targeting next week right now.
Next week. Okay, so the next time you're going to be on this program, you're going to be a NASDAQ stock. This is
very well could be a likelihood. Yeah.
One of our This is you're a good example. Because that's the whole idea. We like to bring those grand floor opportunities, and now you're graduating. But this is only the beginning. Yeah. So here's the thing. So basically, one of the internal catalysts is if nothing else changes, essentially there's a 3x, there's a built-in 3x in the stock just based on the comps. And now you're really it's a legitimate comp. Now that you're a NASDAQ, or you're going to be a NASDAQ next week, the other stocks are NASDAQ, then the institutions can actually it's apples and apples. Before, you were like this weird Canadian company. They don't know what to make of you. It's TSX. It's like too weird. Now it's not. It's like it's a done deal. I think it's a $5 stock.
Look, there were 2 big roadblocks for us, right? And institutional capital in the U.S. is in healthcare, and it's in managed care and healthcare. And you look at our comparables: Oak Street, Agilon, Privia, Kano to come to market, Village MD to come to market. All these companies performed exceptionally well off the hop. I mean, both Agilon and Privia went up, 30, 40%, I think, in their first few days post-IPO. And again, that market is driven by a certain type of revenue. Skylight is going to play in the same field and actually has the same business model that many of these companies do. But the market is so big that it doesn't just take 1 or 2 to dominate the market. And so there's so much room for opportunity. So number 1 was the revenue. And I would say, we're probably 1 or 2 quarters away at the most to being able to now start to have the conversations around that kind of revenue within Skylight's patient base, which is the capitation. We always talk about this value conversion, right? So that's number 1. Number 2 was the exchange. The exchange was a limitation factor. Being on a major exchange like the NASDAQ allows for institutional participation that today can't play. And so we're about to break that down next week. And
at the same time, now that you're a NASDAQ stock, that actually turbocharges your acquisitions, because now all of a sudden, hey, you can give them NASDAQ shares. I mean, that's like a big deal.
Liquidity goes up, attraction goes up, credibility goes up. Absolutely.
The NASDAQ thing, that just, it's like a virtuous cycle. Everything, this is like, again, not every company just because the company goes onto NASDAQ, it doesn't mean all of a sudden the stock is going to be a 10 bagger. It just, because it could be better. But in your case, it's just, it's a major value add. I mean, this is like, I think, incredible.
Yeah, I mean, look, you got to be clear that you're going to have, sufficient news flow. You're going to have the right, levers being hit that the market wants to see. And, I've been saying it for a while. Our pipeline is so robust, and true enough, we've been kind of waiting for this NASDAQ as a catalyst to be able to start to really, move forward on news flow. So yeah, I mean, our pipeline, needs to start closing, and there's just so many more robust deals that keep coming to us that these kind of news on the back of a market that, aligns with where Skylight's operating, where our peers are trading on, sure, that is probably, a much better place to be for all shareholders involved. And yeah, organically, Jack, it's just so exciting to watch, my team execute and sit on these meetings and see what's coming, to the company. And it's exactly aligned with how we should be thinking about our growth. And
I just took a quick look at the stock. I'm shocked that the stock is not $2 right now, because this is like an arbitrage. This is like a classic arbitrage opportunity. I mean, the thing is, this is basically a done deal. This is not like a company saying, yeah, we've applied for NASDAQ. Those things can sometimes take forever, right? Here, you actually already have, conditional approval. The only thing they need you to do is just do the reverse so that you meet the, was it $4 now? They want
$3 minimum.
$4. So you're going to, whatever it is, it's going to be. But so it could be, done deal, whatever, tomorrow morning in theory. So that's a big deal.
I think they asked for 3 days kind of lead time. Not to say that I'm telling the market that 3 days from today is where we're going, but we certainly are expecting next week. So
yeah. Oh, I'm sorry. Is the stock? Oh, the stock is halted right now.
The stock is halted. It got halted.
I was looking at the old number.
I don't know when it unhalts. We've been trying to see it when that timing is.
Okay. So I was okay. So I take back. So I was looking at it. It's halted. So
when you told me, I wasn't sure. I couldn't flip screens. But
okay, so maybe it'll open up at $2. I don't know, whatever. But it's still even at $2, even at $2.50. It's a great arbitrage opportunity.
Remember the valuation of Skylight today compared to our peers is still less than half. So that alone is such a major catalytic close that.
But wait, it gets better. No. So here's the thing, though. So it's not just a valuation thing, because you're actually doing, your model is much more compelling than than the peers in the space. This is not like one of these things that, hey, it's not a Me Too situation. Like, hey, we're a copycat. We're going to just, no, it's actually, you have a very differentiated concept. Please explain to anybody that might be watching for the first time what you're doing differently in the space, like, how you're adding value and which part of you're participating, which is kind of the middle market. Explain that.
Okay, so basically, boil it down, we're buying aggressively through M&A small primary care practices. Okay, now why small primary care? Because most of these clinics are in the older form of reimbursement, which is fee-for-service, and the new form of reimbursement is capitation, which is they start to pay you on a fixed per member per month model. Okay, now to give you an idea of the comparison, if I look at Medicare, which is seniors over 65, seniors in a traditional fee-for-service Medicare earn about $200 a year for the clinic from the insurance company. Seniors under a Medicare Advantage plan, which is a capitation plan, can earn on a global risk about $12,000 a year per patient from the insurance company. The patient's not paying for that amount. It's the insurance company. But the insurance companies are saying, look, docs, we need more of those fee-for-service seniors under a Medicare Advantage plan, because it costs us a lot less downstream if you go under that plan, and the physicians are incentivized to provide more preventative and upfront care. And so they're saying, look, docs, we need more of you to come over. Aetna was actually trying to get close to 75% in value-based care and Medicare Advantage claims by 2020. They're nowhere near that amount. In fact, if you look at the overall senior market alone, which is just a segment of the overall healthcare population, only 20 million of the 60 million are under a Medicare Advantage plan. So there's still 40 million patients that need to be converted over. So what we're doing is basically buying these smaller practices, which have thousands of patients, all under the old fee-for-service model. Then we go in under our platform and we, put all of our quality metrics into place, which include operations, technology, capabilities. Then we're able to then go to the insurance companies and say, look, Aetna, United, Humana, we're ready. And they go, great, we've been waiting for you. And so now we're going to start to pay you under a capitation model, and you're going to start to shift those patients into a capitation plan like Medicare Advantage. And so if I look at one of our clinics that we bought that does maybe $1.5 million in revenue with 5,000 patients in fee for service, just 10% of that clinic's patient base, which is easily Medicare Advantage qualifiable patients, will generate over 7 million in revenue, just 10%, right? So you think about this multiplied by the number of clinics that Skylight has. We've made 7 acquisitions in the last several months, and the number of clinics we're going to continue to acquire, and the value organically that we're going to, when sort of converting that revenue base from fee for service to capitation, that's that major inflection point. Now, our peers are doing this exceptionally well, except they're just going at the end destination. They're saying, no, we're just going to go buy clinics that are already doing it, or we're going to organically do it ourselves, which gets you to the same revenue threshold. But what about the 56% of doctors that'll never be able to get there themselves? That is a massive greenfield. Nobody is focused there. And in fact, we've heard comments like Skylight Health is almost like a white knight to these individual practices, right? We're here to help save them to get to value-based care because they need to make the shift.
So yeah, so so basically it's kind of like we call it a subscription. I'm just going to call it a subscription model. So now that you have the subscription model, essentially, healthcare as a service. I'm going to call it that. Basically, it's a subscription model. So now. So the insurance company, they want to have this kind of preventative stuff happening so that they'll spend let's call it $12,000 a year instead of they might only spend $100,000, but then they're going to get hit with a couple $100,000 something goes bad. Yeah,
because if you think about it, if I'm a doctor today on a fee for service, I'm only going to, and this shouldn't be the case, but because I'm paid this way, I'm only going to do what I can do for the patient based on the billing codes I can bill for. Right? So if my billing codes are not aligned with quality, but rather just aligned with volume of patients, then clearly my focus is going to be on volume over quality. Even though as a physician, yes, I have an altruistic belief in quality.
No,
but now that the payers are shifting to capitation, right, I can go, I'll spend 20 minutes with my patients instead of 5, because if I see 25 patients instead of 30 patients or 50 patients, it doesn't make a difference for me. And the insurance companies go, that's worth more. Because in the long run, that patient's going to end up in the hospital less often. They're going to end up in the emergency room less often. And all of these things add up eventually. So there's more incentive for the insurance company to pay a higher premium to the family doctor, because the family doctor controls over 70% of future healthcare expenses.
Yeah. No, this is interesting. So now, Sean, one of your big investor, he was talking about your new chairman, which we never really talked about before. He was like really impressed by this guy. Can you tell our audience about who this guy is?
Patrick? Yeah, Patrick's great. I think he's an excellent mentor and coach to me personally and to the leadership team.
Background? What's his background?
So he previously to his last 2 sort of larger sort of announced transactions and positions, he ran GE's healthcare services business. And so, very familiar with sort of the GE operating model, obviously ran a very successful and large operating platform for GE in the US. From a healthcare perspective, of course, very ingrained. He then sort of went on to Express Scripts. Under Express Scripts, he basically, through multiple roles, but eventually as EVP and COO, he took Express Scripts from, call it $3 billion in revenue to over $100 billion in revenue, really demonstrating his ability to execute, but also drive real returns to the company and shareholders. And then he was brought on as a turnaround CEO for a company called HIIQ, which I think had a relatively modest to, not so successful IPO. I think when he came on, there were about $3 a share. And then sort of through his guidance, the company eventually kind of got up to about $58 a share. So, he's the kind of guy who understands what it takes to build multi-billion-dollar healthcare companies. He's the kind of guy that understands what it takes from a leadership and a management perspective to actually execute on growth. And he understands what it takes as a board member and a role of a board to support management and help keep them focused, but at the same time, help them execute through their network and through their experience. And so he brings a tremendous network, from a credibility on Wall Street. It's phenomenal. The amount of phone calls I got from analysts, asking me how I got Patrick. I said, I asked myself the same question. And from a leadership perspective, he understands what it takes to coach, guide, and help us as leadership team, take a company from, 40 million or, under 100 million in revenue to where we want to take this company to well over $1 billion in revenue, and how we need to think about growth and scale. And those are all such critical components to delivering on the execution that, quite frankly, when I look at our roadmap, this is not a 5-year journey. This is going to be a faster journey. Our challenge will be keeping up with pace. And, Patrick will tell you, he'll go, speed can be both your enemy, but can also be your competitive advantage. And being able to prepare for that is critical. And so I think, we have the right alignment now in terms of how our board thinks about the company. And I think Patrick just brings a lot more, experience and leadership that everyone's going to benefit from.
No, I mean, this is like, really very, this is like a very unique situation. Because Skylight, essentially, I mean, this is like a blue chip stock that's like $1. It's like a baby blue chip, like we call these baby unicorns. This is like a baby blue chip unicorn, because you have there's a couple things. You got this chairman. I mean, this guy's a massive track record, right? I mean, that's like really impressive. Then you have one of your key investors, which is I always keep forgetting what's the fund, the
Merida Capital.
Yeah, so
actually, I was just on the phone with about a half an hour ago. So,
and their thing is what? Their thing is basically, I mean, they're what is it? They're like they're private equity firm that, and they like kind of the model because they've had very big success with it, with another deal that became like a 50 bag.
Look, there's a few catalysts, right? Yeah. The partners at Merida, they understand healthcare. They understand U.S. healthcare very well, so they know the space we're playing, and they know the size and potential of where we're playing. 2, they've had a very successful, predecessor to Skylight, which was GrowGen. And having seen GrowGen execute on a buy and build model, very similar to Skylight, albeit in a different market, has obviously reflected extremely well in the markets, and has shown, huge capability for a company that executes alongside what GrowGen did. Now, our approach is different, yet although similar in a lot of aspects. And then I think overall, it's very difficult, Jack, to find a PE group that, actually aligns with management in terms of what you need, how you need it, when you need it. And again, similar to Sean, Merida's been with us. When they came in, we were 50 cents. They stuck all the way through with us down to 5 cents. They supported us financially when we needed them. They helped us clear our balance sheet when we needed them. And more importantly, they've aligned with us as a business as we've pivoted and sort of moved through variations, and really been supportive along the way. And today, I think they're getting rewarded for that. But we expect to reward them even more. And being able to execute and show them this potential in this multi-trillion-dollar industry, we're exceptional. And I think a lot of it is because of the strength of our shareholder base. And we've seen more and more float turnover and more stronger hands coming into the story. And that's why we're just so excited for the NASDAQ, because when we speak to these institutions and when we talk to these healthcare funds, they get it. They understand what we're doing. In fact, they have invested and seen it themselves. And so, number one, it's validation. Number 2, it's going to be great to start to see them on Bloomberg and start to know that these investors are behind the company. And number 3, these are the kind of investors that are going to continue to help, support Skylight as we as a management team work hard every day to execute on what we're trying to do.
Yeah, no. So no, it's real. I mean, you have this basically the people that are around you, kind of this kind of team between the investors, the chairman. I mean, these are all like superstars. These are all people who've had 50 bag, 100. I mean, this is like big time stuff. And now the NASDAQ thing. You got Oppenheimer. Who's the bankers right now? You got Oppenheimer, and you have Raymond James. You got Raymond James also doing.
We're still determining the final names, but yeah, we'll.
Okay, but basically, okay. So, but these are like real firms. These are guys who have who have the Rolodex of institutional buyers. It's not this is like
these are the real firms that understand the space. These are the real bankers that know the space, and more importantly, and I'd say of grave importance, these are the right analysts that understand the market and are the ones who have the ear of these institutional clients. And so it's really critical that, you know, we're
essentially this is like real analyst coverage. This is not like some rinky dink, Canadian, brokerage firm. Not to insult Canadian.
Yeah.
This is like big time. This is
I think
big leagues. This is the big leagues.
Have sort of their own markets that they focus on. But the reality is our Canadian analysts are great. They're exceptional. They understand the story and they've really kind of caught on to the U.S. market through Skylight's exposure in the U.S. market and maybe even better than I will articulate that story and understand the value proposition. But you're right. Some of these analysts in the U.S., they've been covering this specific sector for over 25 years. So you have seen the past successes, you have seen the failures, you understand who's in the market today, and you know how to poke at why are you going to be any better or different than the guys who tried it before you. And so I think we've been able to demonstrate that. And it's true. What Skylight's doing is uniquely different. And it's not to say the other ones aren't doing it. It's not one is better or one is not. It's we have found a way to create a niche for ourselves that gets us to a destination in that sort of multi-billion dollar revenue space. And it's working, and we're just going to keep executing it.
Yeah, no, I mean the thing is again, it's like it's really what a great timing situation, because again, the institutions love the store because it's one of these things that, hey, it's got the key word here is scalable. It's a scalable thing, which they can say this, the only question is how big and how fast can you scale, but they understand it. So this is like a stock. I mean, this is like basically like it's a built-in triple right here from the stock. I mean, I'm not giving
look, the question
is not the
questions they ask us. The questions they ask us, like, okay, one, do you have a market for growth? So, check. Yes, we have hundreds and thousands of clinical practices out there that fit our disciplined price acquisition model. Okay, good. So there's the total addressable
disciplined market. Price acquisition model. Very key. Very key. Meaning you're not overpaying. You have a very.
Yeah, we don't need to stray. We don't need to pay up. Right. Number two, what is your value proposition? Okay, well, our value proposition is helping these practices transition to value-based care. What does that require? It requires infrastructure development. Are we doing that? Yes. Check. Okay, good. Number three, have you actually delivered the value-based contracts? Well, I'll tell you, our valuation today represents less than where we should be. But once I check that third box, once our team gets through checking that third box, in the next quarter or two, that's it. At that point, story A to Z is formed. I can now tell you, we buy a clinic here, in 6 to 12 months, this is what they're going to be worth. In 12 to 24 months, this is what they're going to be worth. Now, I'm just going to go keep buying up these clinics, and you can start to project the revenue moving forward. And the reality is that's the benefit that these investors are getting in coming in earlier with Skylight. They're not waiting for us to go to A to Z, have a much higher market cap and an entry point, and then participate. They get the opportunity of riding up to get there. And the benefit here is we don't have to prove those contracts. Those contracts already exist. The demand is already there. So all we have to do is be able to prepare ourselves to go in and take those contracts.
Okay. So let's do a quick recap right now. You have the run rate with the existing deals that you have. What's the run rate approximately right now?
I'd say we're probably close to 50 to 56 million.
56. And you also, I think you said, if I remember, you want to exit this year with 200 million plus revenues.
I think in terms of our existing opportunities that we're sitting on today, I think we have well more than that already with the conversion. I think organically the pipeline will continue. Look, it's really important that we don't end up moving away from price discipline. And why the market really likes this right now is that there's this very massive population of practices within a 10 million and under revenue range. And the fact that we can stay focused in that space is the most attractive opportunity for investors looking at the story today.
Okay, so this is this is like the key differentiator between what you're doing when like private equity does. You're focused on these practices in 10 million or less, basically, right?
We are. We're not turning our attention away from the larger ones.
And why? Because what the valuation? Explain your reasoning here. Why you're doing this?
Because we're not ready to pay up. We don't need to pay up. I have so much value within the smaller practices once converted to capitation that I don't need to go and pay 10x or plus for a larger deal just to get a higher revenue. The US analysts don't reward acquisition-based growth if there's no real value creation. And the larger ones might have more challenges with value creation. So why pay up for a deal when my largest growth factor is going to be organic growth? I'd rather be scooping up these 10 million under practices for favorable prices all day long, bringing real value to those clinics, but then ultimately recognizing that value in the conversion of the revenue base. So if we do find a larger transaction, it is strategic. Maybe it is a little bit more expensive. It makes sense. We'll see. Or I find a larger transaction at a favorable acquisition price. That makes more sense. But I think to compete with the private equity groups in the larger deals with the higher multiples, I don't see why that necessarily aligns.
You don't want to get involved in bidding wars, basically.
Right. That's not the best use of our capital, not when we can deliver much more value for a lower cost of capital.
Makes perfect sense. I want to touch on something you mentioned earlier. So Merida. Okay, so Merida. So okay, you mentioned something interesting. Originally, they were an investor in the 50-cent range.
They were,
and the stock got down as low as a nickel, I think, right?
So,
less. So okay. So these guys, and these are smart guys. It's not like retail guys or just throw a dart. No, these are smart guys. So they were down almost 90% at one point, and they wrote it out, and now they're back. So which is a takeaway for investors who, because right now, look, the market has been very choppy the last few months, as you may have heard. There's a lot of stocks are down. 50, 60, even 70%, 70% in some cases. So, the market is, you got to basically, in this part of the world, you got to, be willing to take a hit before,
I think Merida is a good example of your investor base that says, look, we know what the value of your company is. If nobody else sees it today, keep going, they will one day. And so, that's the message we always got. And it was always, look, keep doing it. We believe in what you're doing. We're here to support you. But at some point, the market will catch on. And when it does, it'll make a lot of sense. And so, that's, again, why we're so lucky to get a group like Merida as early as we did.
No, this is incredible. So everything is I mean, like, you're firing on all cylinders. This NASDAQ thing is incredible. Let's do what's coming up. What you have other acquisitions you're looking at? What can we look forward to in the next few weeks? Next
one is the NASDAQ. That's the number one priority.
Okay.
Number two, yes, we do have some acquisitions that we're going to start to close on and announce. And then again, just that allows us to keep going in the pipeline to time the next acquisitions for closing, because there is quite a few in the pipeline right now. And our challenge right now is, being able to get as many in and handle them right now. So that's a good problem to have. And then number three is probably Q1 reporting. So we'll report Q1 at the end of May. And I'm excited because Q1 is going to be the first, let's call it official quarter post Skylight sort of rebranding and reinitiation of the acquisitions, that those acquisitions made in Q4 start to reflect. Q2 is going to be even better because obviously we closed Rocky Mountain in Q2, but Q1 will be, I know a lot of questions came up at Q4, but that makes sense. Most of them would only have been reflected in Q1. So you'll start to see, that growth trajectory starts in Q1 and really accelerates into Q2. And you'll continue to see that now because, like I said, we put ourselves in a position to continue to execute and grow. So, the next few weeks that will be lined up here.
Okay, so the numbers coming out at the end of this month, they're going to reflect the new Skylight model.
They will. They'll incorporate some of the acquisitions made in Q4. They'll incorporate some of the acquisitions in Q1, but again, partially through the quarter, because again, we've closed on some of them only in end of Jan or in February. So those ones will reflect partially. And then they'll reflect in full. So Q2 will be our first full reporting quarter with all acquisitions made to date, not including whatever we will now acquire still moving forward.
Okay, so this means basically that, so the second quarter, so now that you have this kind of, you're going to have this institutional following, you're going to have these institutional eyeballs look at the stock. That's what these guys want to see. They want to see the kind of the comps quarter, and now so this really could be, massive value creation in the stock in over the next, I think there's a window basically now the next 6 months where there's going to could be a huge gains made.
Yeah, and I remember when we exited Q1, when we exited year end, I think we were at about a $20 million run rate, right? That's what we said, based on the acquisitions we had and the ones we'd announced that were closing in Q1. So that, similarly reflected in sort of where we expect Q1 to be. And then when we closed Rocky Mountain in April of Q2, the guidance went to 40 million, right? So you'll start to see that reflection of that quarter in accordance with where we start to see the yearly revenue going. So I think the continued acquisitions, and this is one of the things we've done, we've moved away from announcing LOIs because sometimes you want that flexibility to be able to find a better deal. And we do that. When we find a deal, we're an LOI and we go, okay, we have this option. Now these 3 options have come in. We really like this one, maybe better. We're going to flip it around. So from a timing perspective, it gives us a lot more flexibility. But also once we announce the LOIs, once we announce the deal's closing, that's it. You can count it in the books. Next day on, it starts to reflect on our P&L. So we prefer that methodology better. And given the nature of the number of deals we have, it's just you're going to see continuous news flow. It's not like we have to use LOIs to cover a gap between acquisitions. So, from that perspective, we'll continue to raise guidance through the course of the year. I think it's a much more disciplined approach. Again, from a more disciplined board and advise and counsel from them. And so we're going to adopt that principle and methodology. And as we look to graduate onto the big board, make sure we start to sound like our peers and make sure we set expectations like our peers as well.
Okay, Brad, on that note, last question I want to ask you, so right now, based on this moment in time, top 3 reasons, in your opinion, why investors should consider the stock today?
So number 1 is obviously,
I think we've mentioned like 1,000, but why don't you boil that?
The big key reasons? Okay. You're talking about a massive unaddressed market in the US in this sort of large multi-trillion-dollar healthcare industry. We all throw out big numbers out there, but the reality is it's really, really true. And you look at the companies coming to market and the multiples that they're achieving, there really is a lot of institutional capital and a lot of focus in this market space, but there's still so much market to still attract. And we do have a very unique model of getting there. Number 2 is our internal management team. We're stronger than ever. We've got such smart people around the table and we're executing right on mark. So, I'm looking forward to starting to see some more of this organic news flow coming through and supporting the acquisition-based growth, which of course the pipeline is so robust and so full. And then lastly, our near-term uplisting onto the NASDAQ is just going to be such a pivotal moment for us because it's opening our market up to a broadened set of institutional investors that understand and get the industry we're playing in. And, manage a lot of capital and have the ability to really deploy capital towards Skylight Health, and we bring them a unique value proposition given how early in the evolution space we are compared to where today they have to go and buy these companies. So I think those are 3 among many, but certainly 3 reasons why you should consider Skylight.
Fantastic, Brad. Thank you. Congratulations on this major milestone. Always great to have companies on who really achieve, this is like graduation day kind of thing. So this is classic staircase growth. This is basically So all right, Brad, thank you. We'll catch up with you in a couple of weeks. Hopefully with some more news.
Thanks, Jack. Thanks for having us on.
Thank you everybody for joining us today. We'll see you in the next live stream.